In the world of stock market, everyone likes to talk about multi-baggers and people who created wealth like Rakesh Jhunjhunwala. But tell me friends, what about the failure stories? Every year, millions of people in India end up losing money in the stock market. But nobody likes to talk about it. There's a very good saying, we can learn more from our failures than the success. So in this video, I have curated a list of 7 common mistakes people make in stock market which result in people losing money. And then I have dig deep to identify 5 major human psychology factors that is the root cause of all the problem. Hello everyone, my name is Sahil and this is my Personal Finance Academy where I explain everything about money management in layman's language. Friends, this video is a result of an extensive research that I have been doing over the past few years. Watch it till the end and I am sure you will appreciate the content. Alright, let's get started. First mistake is investment in penny stock. Many people have an obsession with penny stock. They think that when they invest in penny stock, the downward risk is very low. For example, if they invest in a stock worth rupees 5, then they think that at most they would lose 5 rupee per share. But the upward potential is huge. Friends, 1 out of 100 penny stock have upward potential, rest all have downward risk. And how much you can lose? You can lose all your money. In fact, I asked many people why they like penny stocks and many of them said that they like to get high units. This is again a huge misconception. For example, there is a share worth rupees 10. Let's call it share A. And there is another share B worth rupees 1000. Now people think that if they invest rupees 10,000, they will get 1000 units of share A and only 10 units of share B. So let's invest in share A. Folks, this is not the right way to invest. In fact, share price has got nothing to do with valuation. A share worth rupees 10 could still be overvalued than a share worth rupees 10,000. For example, MRF is a classic case. It is currently trading at rupees 86,000, but it is still reasonably valued. Yes, it is not overvalued even at rupees 86,000 per share. By the way, do you know which is the costliest share in the world? Some of you would have guessed it. It is Berkshire Hathaway, the company of Mr. Warren Buffett. Do you know the price of one share of Berkshire Hathaway? It is 3.67 lakh USD. In other words, it is 2.7 crore rupees. Yes, one share is worth 2.7 crore. So share price has nothing to do with valuation. Majority of people lose money because they end up investing in penny stock. Next mistake is no idea of valuation. Valuation? What is valuation? If I ask 100 people, majority of them have no clue about valuation. They just invest because they think that the share is good or someone suggested the share. My friend, valuation is the most important criteria along with the fundamentals of the company. No matter how good a share is, no matter how good the future growth potential is, if the share is super expensive, it won't give you high return in the future. Majority of people lose money because they end up investing all their money in super expensive stocks without looking at the valuation. Next mistake is they follow the herd. This is the biggest problem in our country. Majority of people end up investing in companies where their colleagues have invested, friends have invested or relatives have invested. It is like डूबेंगे तो साथ में. On a serious note, I have seen many people simply investing on tips from friends, family member or colleagues without even knowing anything about the company. They have this blind faith. Again, a major reason of losing money. Next mistake is people look for 52-week low. Many people have the tendency to invest when the stock touches 52-week low. यार और कितना गिरेगा? This is the attitude. भैया और भी गिर सकता है. Majority of people avoid stock at 52-week high thinking यार और कितना बढ़ेगा? It doesn't work like that. You can't simply avoid a stock just because it is at 52-week high or can't simply invest just because a stock is at 52-week low. But on the other side, there are also people who just invest looking at high returns in the past. They invest when the company has already given bumper return. No, both the approaches are wrong. A stock at 52-week low could even fall further if the stock is fundamentally weak. But if a stock has fallen to 52-week low due to external reason like COVID and the stock is fundamentally strong, then it makes sense to invest. Majority of people end up investing in poor quality stock at 52-week low. And a stock at 52-week high can either fall or rise based on the fundamentals of the company and future growth prospect. Next mistake is people avoid quality stock. I don't understand why, but people have this कीड़ा to identify hidden gems. यार HDFC बैंक तो सबको पता है, कुछ और बताओ. टाइटन, रिलायंस, TCS तो सबको पता है, कुछ और बताओ. ऐसे स्टॉक बताओ जो किसी को नहीं पता. Many people lose money in market because they simply avoid the real gems and keep searching for the hidden gems. There's another problem. People not only avoid high quality stock but end up investing in poor quality stock, and when the share price fall, they invest even more to average out the price. Friends, this is a recipe of disaster. Next mistake is they end up investing in day trading and F&O. Many people want to make quick money in stock market. As a result, people end up doing day trading and even invest in futures and option. Friends, I've already mentioned that day trading is not everyone's cup of tea. You need to be a professional trader. Many people lose money in stock market as they end up investing money on day trading and especially in F&O by buying huge lots on leverage and even on borrowing money from others. When they lose money, they invest more with a hope to recover their lost money and end up losing even more. Final mistake is people never learn from history. For example, if today Sensex is at 50,000, people think that it will only go up. But my friend, if you look at the history, you would know that if market rise, it also fall. And when it falls, it eventually rise. People today are going gaga about technology stock. They are willing to buy technology company at any valuation. I'm not saying that they are bad. But if you look at 2000 dot-com bubble, there was a time when every internet company was attracting super expensive valuation even without any profitable business model. Eventually, the bubble burst and people lost money. So don't just invest in a company because it is a technology company. Look at the financials, business model, and of course, the valuation. Likewise, today everyone want to apply for IPOs. Every IPOs. भैया ऐसे नहीं होता है. Not every company that goes for IPO is good. I keep saying that investing is not a science. There is no fixed formula. It is more of an art. If investment was all about finance and numbers, every finance and economic professor would be a millionaire. The biggest factor that decides the success or failure in stock market is human psychology. So I have identified 5 mental reasons why people make so many mistakes in stock market. First reason is thrill. People need thrill. Folks, listen to me carefully and understand this human psychology. If I give you 2 options of investment, first is a Nifty 50 index fund that can give you an average of 10% annual return for next 10 years versus an active mutual fund that can either give 15% return or can also give 5% return. What would you choose? Majority of people would go with active mutual fund because if you know an average 10% return, then there is no thrill. On the other side, even if there is a slight chance of 15% return, then you want to take that chance even though there is huge downward risk. This is the reason why index funds are not so popular in India. On the other side, if I tell you that a stock can give you an average 20% return for the next 10 years versus a stock that can either give 100% return or can also give negative return, then majority of people would go with option 2. Friends, I love to understand human psychology. In fact, I want to share a brilliant story of how Google Pay became such a hit in India. When Google Pay entered in India, people used to transact with Paytm. So earlier, Paytm used to give rupees 100 or rupees 200 as cashback, which can be used in another transaction. But Google Pay did something extraordinary. Do you know what was that? The problem with Paytm cashback was that people already knew the amount they would receive. So there was no thrill. Google Pay introduced a scratch card system. So you make the payment and get a scratch card. Now this was a $1 billion idea. Since people didn't know about the cashback they would receive, it created a thrill in their mind. And Google Pay started with giving good cashback. So if someone make a payment of rupees 500 and got a scratch card with a cashback of rupees 100, the person was thrilled. He did not expect this. This releases dopamine in the body, which is the hormone responsible for happiness. So dopamine is also known as feel-good hormone. So he started sharing his Google Pay experience with friends and all over social media. Instantly, Google Pay became a hit. In fact, this strategy was so brilliant that it would cost Google Pay less than Paytm cashback, because later Google Pay reduced the cashback on scratch card and many times the scratch card would show better luck next time. Still, there was a thrill. And friends, if you are wondering, Google Pay guys must be a genius, this concept is nothing new. We humans have always been thrilled by these scratch cards, and hence the concept of lottery has been prevailing in our society for hundreds of years. It is just that Google Pay has made an online version of it. Later, Paytm also followed the same strategy. In fact, this dopamine is the main reason why people are glued to social media. The urge to get instant gratification with someone liking your photo. Anyways, let's not divert from our topic. If you need thrill, please visit Goa or Vegas. Real investing is boring. It is like watching paint getting dry or watching grass grow. Next reason is greed. This is again a big problem. यार 10-15% नहीं, 40-50% वाली कंपनी बताओ. Greed is the reason people end up investing huge amount of money when the market is at top. Greed is the reason people end up borrowing money to invest in the stock market. Greed is the reason people end up investing in penny stock. Greed is the reason people end up doing day trading and F&O. And greed is the big reason why people end up losing money. Next reason is lack of patience and discipline. यार ऐसा स्टॉक बताओ कि 6 महीने में पैसा डबल हो जाए. This statement sums up the mentality of majority of investor. Everybody wants to get rich, but nobody wants to get rich slowly. If you study Warren Buffett, he became a billionaire at the age of 56. But majority of people lack patience in investment. In fact, if they invest in a great stock or mutual fund and it doesn't give return in next few months, they end up selling it because they simply don't have the patience. Another factor is discipline. Discipline to invest systematically at various levels in spite of market volatility. Discipline to stay invested in the market. It is not easy. And the majority of people lack discipline. Next reason is they can't handle the pressure. Friends, you need a lot of conviction to go against the wind and stay invested when the market falls. Or in fact, invest even more during the fall. But conviction comes only from knowledge. That brings us to the final root cause, which is lack of knowledge. यार सीखना नहीं है, बस टिप दे दो किस में पैसा लगाएं. This is again a major culprit in people ending up losing money. Unfortunately, money management is not a part of school curriculum in India. Nobody teaches it. Nobody likes to discuss about it. जो हो रहा है होने दो. No wonder every year millions of people in India end up falling in various financial traps and destroy their financial life. I wish to spread the knowledge and educate every Indian about money management so that they don't fall in any financial trap. Hence, I have created a complete course on everything about money management. Friends, even I am not perfect. Sometimes I also get carried away with good stock available at expensive valuation. So if I know that a stock is really good with great management, great financial and great future, then I sometimes end up buying the stock even if the stock is available at super expensive valuation. Although I make sure that I don't buy a lot. Sometimes I also get impatient when the stock I invested in does not show a good return. Then I tell myself, Sahil, keep patience, believe in power of compounding, do not get carried away. Sometimes I also find it difficult to handle the pressure when I invest in a good stock and the stock price tank. Then again, I remind myself, you invested after the research. Now don't lose your conviction. In fact, if the share price has fallen, then invest more. Friends, this knowledge is a result of years of research, of reading great books, blogs, and discussion with people. I have tried to put it in a nutshell. I hope you will appreciate it. Let me know if you like this video. I will see you next week with another video. Till then, take care.